Now we're at almost 2,800. But I think this move is going to be at a minimum proportionate to the move that preceded it. So gold went up about sixfold to go from 300 to 1,900. And so this move should be at least sixfold, which is 2,000 to 12,000. So kind of at a minimum, you'd think gold is going to go to 12,000, but I don't know why it would stop there. I think it's going a lot higher than that. My base case scenario is that we avoid 1987 or, more like a 1929 style stock market crash. We're not going to have that. Instead, we're going to have a dollar crash. Nominally, in a dollar collapse, the Dow could go up, but it's not going to matter. Let's say the Dow, which is, 40,000, let's say the Dow goes to 100,000. Yeah, but what if gold goes to 50,000? Now, the Dow is just worth 2 ounces of gold.
Gold, currently around $2,800, is expected to rise significantly, potentially mirroring its prior sixfold increase to a minimum of $12,000 and possibly much higher. In a dollar collapse scenario, the Dow may climb to 100,000 nominally. Still, with gold at $50,000 an ounce, its actual value would drop dramatically to just 2 ounces from 16, signaling a severe real-term collapse despite the higher nominal figure. A prominent American economist, financial commentator, and stockbroker, PeterSchiff, explains the U.S. is facing soaring deficits, adding $3 to $4 trillion annually to the national debt, with interest payments now at $1.1 trillion per year, soon to surpass Social Security as the largest budget item. This debt will be financed by printing more money, leading to a weakened dollar and much higher inflation. Gold will likely outpace inflation as investors seek an inflation hedge. Historically, while the Dow has increased fourfold since 2001, gold has surged over eightfold, revealing that in real terms, the Dow has lost around 50% of its value when adjusted for the dollar's declining purchasing power. The recent BRICS summit emphasized reducing reliance on the US dollar by trading in local currencies and increasing gold reserves. This move has supported rising gold prices, driven by Eastern and emerging markets like Poland. Western nations have yet to join this trend, but gold demand and prices could increase significantly if they do. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
It's not that gold's going anywhere. They're going to print a ton of dollars. We've got massive deficits in the United States. We're running about $1 trillion, every 4 or 5 months of debt. So we're adding like 3 to 4 trillion a year to the national debt. Interest is now $1.1 trillion a year. It's the second biggest line item in the budget behind Social Security. Probably by the end of next year, we'll be paying more in interest on the debt than we're paying in Social Security. And where's all the money going to come from to pay that interest, as well as fund the operating deficits? They're just going to print it. And so the dollar is going to get killed, and the price of everything is going to go up. If you thought we had bad inflation last year, wait till you see what's coming. And it doesn't even matter who wins the White House. Inflation's going much, much higher, and the gold market is eventually going to figure this out, and then gold's going to even outpace inflation because people are going to be looking for an inflation hedge. They're going to see this freight train coming, and they're going to try to get out of the way, and they're going to try to protect their purchasing power, and they'll do that by buying gold. When this century started in 2001, the Dow was around 10,000, well, maybe 10,400, but just above 10,000. Gold was just around 300, and gold has gone up more than 8 times, whereas the Dow has only gone up a little over 4 times. So what is that telling you? That's telling you that the Dow didn't even go up. The Dow has lost about 50% of its value over the last 24 years. That's what gold is telling you. See, when we're pricing the Dow in dollars, the dollar has lost a lot of value. And so that gives you a false sense of what your wealth is. BRICS summit in Russia, and they didn't announce any kind of deal to form a new currency. But what they did make clear is that they're moving away from the dollar. So they're going to try to trade with one another bilaterally in their own currency. So if Russia wants to buy something from India, the invoice will be in rubles or in rupee. It won't be in US dollars. That's what they're going to try to move away from, is using the dollar to trade, among themselves. And also they're going to be holding fewer dollars than they have. And so they're going to allow their dollar reserves to go down. And that's why you're seeing what's happening with gold, because that's what they're doing. They are slowly replacing their dollar reserves with gold reserves. And that trend is going to continue. It's just getting started. And, that's the main reason that the price of gold, I think, is rising, but you're not seeing, silver rising because they're not buying silver. They're just that they don't have the capacity to store that. So they're just buying gold, and they're not buying gold mining stocks either. They're just buying the actual gold. And while investors who would be buying those other metals are still clueless about what's happening. But imagine how much faster the price of gold is going to go up when the central bankers have to compete with private investors who are right now not even in the market. When the Western central banks, because the U.S. hasn't bought any gold, they're not buying gold in the U.K. or Germany or France. It's the East that's buying the gold. It's the emerging markets. Look, Poland now has more gold than the United Kingdom.
PeterSchiff points out that before 1913, the U.S. government operated with minimal taxation, relying mainly on tariffs and excise taxes, as the Constitution intended. The federal government spent less than 2% of GDP, enabling budget surpluses most years between 1870 and 1890. This period saw strong economic growth, low taxes, and a small government, fostering widespread prosperity and attracting millions of immigrants seeking opportunity. PeterSchiff specifically highlights the 1913 introduction of the income tax, which changed everything, enabling government expansion and higher spending, now at 24% of GDP. Initially pitched as a minor tax on the wealthy to relieve middle-class tariff burdens, income tax rates quickly escalated. By World War II, middle-class Americans were paying rates never intended, with withholding taxes implemented and taxes climbing to 30 to 50%. The promise of only taxing the rich evolved into a system impacting all Americans, illustrating how government overreach grew alongside income tax revenues. Now let's get back to the interview.
We have to recognize the reality and the differences between 1912 America and 2024 America, because before 1913, the government was able to run predominantly on tariffs. So not predominantly, that was maybe about 40% of its revenue. But they most of their revenue was either tariffs or they taxed liquor, tobacco, fire, stuff like that. They ran on excise taxes, indirect taxes, which is what the Constitution envisioned would finance the government, in peacetime. It was only during wartime that they thought they might go to a direct tax. And that's why they made it very difficult for the government to levy a direct tax. But back then in 1913, the federal government spent less than 2% of our GDP. So when you have a tiny federal government that doesn't spend a lot of money, you can cover the spending with tariffs. And Donald Trump mentioned in his speech, the period of time between 1870 and 1890 as the glory days of the Gilded Age, and talked about how we ran on tariffs, and the government ran budget surpluses for 15 out of those 20 years. So out of the 2 decades, the government actually ran a surplus 3/4 of the time with only indirect taxes. There was no income tax, either personal or corporate. There was no payroll tax, no Social Security, no Medicare, but the government was small. Today, the federal government, not even counting the state, just the federal government spends 24% of our GDP. So it's more than 12 times as big as it was before we had the income tax. And that's not a coincidence. The reason the government is so big is because we have an income tax. That's what enabled the government to get the revenue to grow. If they didn't have a direct line into our pockets, they never could have expanded the way they did. So it would be great to go back to the 1913 tax system, but that means we have to go back to the 1913 government. So we got to get rid of Social Security, Medicare, Obamacare, all the stuff that the government does now that it didn't do back then. But we had a better country before the government did all this stuff. We had a more prosperous country. Economic growth was more than twice as high before we had the income tax as it is now. And it was real economic growth that went from the bottom up. I mean, people were lifted out of poverty. People were coming to America, millions at a time. Immigrants were pouring into America because we were free and prosperous, because we didn't have a big government. We didn't have all this social welfare. People just came here and went to work. And, and everybody benefited from the freedom that we had when government was small. And now people are suffering from the freedoms we lost because government is big. And government got big with the income tax. So yes, and ironically, people don't know this, it was a trade-off. What the politicians at the time said to the people is, you're paying all these tariffs. Why don't we have an income tax on the rich so we can get Carnegie and
Oh.
Rockefeller and Vanderbilt. We can get those super rich guys to pay an income tax of like 1 or 2%. And they can afford it because they're super rich, right? They're not paying their fair share. So let's put a little tax on the rich, and then we can get rid of the tariffs that are falling on the middle class and the poor. And that was the deal. And that's what they said. Yes, we need an income tax so we can get rid of tariffs, because everybody knew back then that the middle class paid the tariffs and the rich would pay the income tax. And now what Trump is promising is to bring back the tariffs, but that actually goes on the middle class. But he's trying to pretend that the middle class isn't going to pay it, that China's not going to pay it. But, ironically, the initial tax rates that they bandied about, was 1%, 2%. I think the max was 6%. Like that was the highest. And I think there was initially the initial income tax. They thought about putting a cap of 6%. I think they said, well, no, they didn't want to put a cap that high because they thought people might actually get up there. They didn't even expect it to get that high. But it didn't take long before the income tax got to 80, 90%. And, by 1942, when the Second World War started, we had the income tax for the withholding tax for the first time. And Americans were paying 30, 40, 50% tax. Middle-class Americans were paying income taxes at rates never imagined for the Carnegies and the Vanderbilts and the Rockefellers. So that's what happens. You make a deal with the devil, right, and you're going to get screwed.
The current economic landscape, marked by rising deficits and inflation, pushes investors to use gold as a hedge, especially as international trends shift away from the US dollar. Historically, the expansion of government spending and taxation since 1913 has impacted economic growth and wealth distribution, highlighting the consequences of fiscal policies. These factors may lead to further significant shifts in global financial dynamics. How might Western central banks' potential future purchases of gold impact global markets? What lessons can be learned from the economic policies of pre-1913 America that could inform current fiscal strategies? Share your feedback in the comments below. If you found this video useful, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.